Hello all, welcome back. We're having some fresh news about Snapchat and you will see that it's currently down almost 30% right now. And let's see what happened. We can take a look at the stock news module. And Snapchat shares fall as CEO says that company will miss revenue and earnings estimates, plans to slow hiring. Let's examine the details here. This is interesting. So it's plans more than 20%, as we saw, is almost 30% right now. After the CEO warns company will miss revenue and earnings estimates and will actually slow hiring as well. So let's take a look at what happened here exactly. They filed an 8K saying that the macro environment has deteriorated further and faster than they anticipated when they issued their quarterly guidance last month. And so as a result, the revenue continues to grow year over year, but it's growing more slowly than expected, it looks like. Interesting. In April, they actually missed on earnings. This is what we read here. And at that time, the company said it expected between 20 and 25% year over year growth in revenue. So it forecast adjusted earnings before interest, tax, depreciation, amortization, that's EBITDA, of between 0 and 50 million. And now they say that we believe it is now likely that we will report revenue and adjusted EBITDA below the low end of the guidance range, so below 20% that is for this quarter. Very interesting. They will also slow the pace of hiring for the rest of the year. He still expects Snapchat to hire 500 new employees, but the company hired about 2,000 employees over the last 12 months. And they are also talking about facing rising inflation, interest rates, supply chain shortages, the usual stuff. Interesting. So let's examine the company and its stock price since we are actually at it already by taking a look at the news. Because we want to see now, this is going to be having a massive discount. It's going to be at $16. So let's see how that reflects to the actual price of the stock and whether this makes it a buy. Because these kinds of moves, we need to re-examine these companies when they happen. Now, the P ratio of the company was negative, which means that they are losing net income, they are losing money, they are not profitable. The price to free cash flow ratio is very elevated at 202, and outstanding shares very high. They have been getting higher and higher. The company is diluting shareholders a lot, and quite some debt here. The free cash flow to the total liabilities, this is probably limited free cash flow compared to the debt that the company has. Now, the revenue growth has been insane, of course, for the company, but other than that, net income growth, as you see, it's better, of course, but it's still negative. And free cash flow growth is marginally positive. This is why this is 20 here. And total equity growth increasing a little bit, mostly because of the outstanding shares, of course. Now, the debt that the company has compared to its equity is not that high, but all the returns are negative, as you would understand. I mean, the company is not profitable. Now, let's take a look at the income statement, see what's going on. 800 million to 4.1 billion. So that's good growth in sales, of course, pretty great. And they're actually growing their net income. That's at least nice to see. They are still negative, but they are growing it. So this is nice. I like to see that. Even if we're talking about a non-profitable company, at least when you see a positive pattern, you are getting at better territory. But I don't know if this is going to continue. Bearing what they said about the next quarter, I don't know if it's going to continue the next year. It is a positive line here, pretty much, if you chart this one. So this is interesting. The balance sheet of the company has been increasing, not tremendously as well, but increasing because of additional paid-in capital. The company is issuing massive amounts of shares, and so they're getting 10 billion, 9 billion out of this one, a lot of money. And cash flow statement here, this gets into positive territory because of the adjustments to stock-based compensation. A lot of the expenses of this company have to do with paying employees with stock, and you'll see it's only actually this year was much higher, but they have been paying a lot in stock-based compensation here, and this gets reflected to net cash provided by operating activities because this gets added back to that because it's a non-cash expense. Okay. Net cash used for investing activities is slightly positive here. It looks like they sold some stuff. Yeah, so selling maturities or of investments. And cash from financing activities at 1 billion over here. Again, this is positive. The company is incurring a lot of debt pretty much every year. So a lot of debt in the billions. That's interesting and not great. And they do have about 2 billion in cash, and you can see the line in terms of the free cash flow, which is also getting better here and actually became positive. So the company is not profitable, but at least it's becoming better in terms of what kind of money they're making. So this is interesting, and let's examine what kind of price to pay potentially for this one if we want to buy it. Now remember, when we want to buy a company that is not profitable, we have extra risk because we need to actually calculate potential profitability for when that happens. And so with the tool here, we will be acting as if the company is becoming marginally profitable, and right now they are not, although they are getting there, it looks like. So the revenue growth is probably going down, and so I'm gonna take it to like 10, 12, and 14. And the net income margins here that I'm looking at, they have to be a little bit positive here. So I'm gonna go 1, 3, and 5. We will do our projections as if the company is actually profitable right now, marginally profitable, making 1%, 3, and 5% in terms of net income margins here. And the free cash flow margin, I'm gonna use something that is rather typical because this is very atypical, of course, because the company's net income has been all over the place. So you can understand that this affects the free cash flow margin. And so we're gonna use something typical 80, 90, and 100%. And the annual return of 13% is what we can use here. We could potentially use even more because we have more risk here. It's not a profitable company. But let's try 13% and see what we're getting. Okay, so even at 13% here, we are still having a high estimate here of $3, while our current price is going to be near 15 tomorrow. And that, of course, makes a ton of sense because the company hasn't been profitable. And also remember that if you take a look at the price to free cash flow ratio, for example, this is very, very high, meaning that the company doesn't generate enough free cash flow to actually sustain, to make a sustainable source of income, a sustainable source of free cash flow when you compare it to the price of the stock. It's actually much elevated, the price of the stock, compared to what they are doing in terms of their free cash flow. And the P ratio is even negative. And so remember, the company is losing money. And so it looks like right now this company is definitely not a buy. Even after it's gonna drop a lot, it's very, very expensive. And even when we are making a hypothesis that the company is going to be profitable, even then we're getting a much lower prices than what we are today. And yeah, this is not looking like a company that I would like to invest. But we did have to examine it because it went down massively. And so people may be looking at it and be like, okay, it has dropped a lot, maybe it's time to buy. But you know, something that drops a lot can drop more. And we don't want to be buying stuff because they have dropped. We want to be buying stuff because they are good companies and potentially have dropped in price, giving us a nice entry points. This one doesn't look like it. Thank you for watching the video. I hope you enjoyed. Please leave a like and subscribe. And remember, you can gain access to this tool by becoming a Patreon. You can find links in the description box below this video. And I'll see you in the next one, guys. Bye-bye.